Do not make these 10 investing mistakes in 2022. Are you an investor? Are you terrified of losing money on investments? Are you worried about how to avoid mistakes while investing? Then stop worrying at this very moment because we have got you covered. We'll discuss the top 10 mistakes you should avoid when investing in 2022. So watch this video till the end. Keeping track of your finances can be a real pain in today's world of rising costs and lavish living, but being prepared and making early preparations helps a lot. Knowing how much money you bring in and how much you spend is crucial. Similarly, this is necessary if you want to invest your money wisely. Investing is essential if you intend to have enough money to support yourself in retirement. Nonetheless, many people either don't know where to begin investing, are afraid of losing money, or are curious about what they should not do while trading stocks. Investment is the best strategy to grow your money, notwithstanding market fluctuations. However, investors of all experience levels make the same basic blunders. Here are some suggestions to help you get the most out of your savings and investments. Number 1. Firstly, not making a proper financial plan. Creating a budget is simply deciding in advance how you'll handle your money. Preparation is the key to the successful completion of any endeavor. The same is true of your bank account. You do not need to know the intricacies of accounting to create a budget. Just keep track of your monthly income and expenditures. You now have savings to put toward future purchases or investments. The 50-30-20 rule is the most efficient method for allocating your budget's resources. This guideline states that 50% of income should be allocated toward meeting requirements, such as food, clothing, and medical care. It's okay to spend 30% of the rest of the money on whatever you choose. This can be anything from going on a dream vacation to treating yourself to a fancy supper and a movie. A lot rides on that final 20%. Keep this money aside to settle any outstanding bills. Once you've shed your yoke, any surplus funds are yours to put toward future goals like saving or investing. 2. Making emotional decisions. While investing has the potential to be a very personal endeavor, it's important to keep in mind that at its core, it's a business. When investing for the long term, it's tempting to let your emotions get the best of you if a share or the market as a whole has a short-term loss. Try not to make snap judgments or let your emotions get the best of you when things don't go as planned. Check your account less frequently, perhaps once a month, to reduce the likelihood that you will make an irrational decision based on what you see in the business news or your account balance. You can feel more confident in your investments and tune out the noise if you educate yourself about investing and economic cycles. 3. Not educating yourself about the stock market. Knowledge of the stock market's fundamentals is necessary for any investor. You'd benefit greatly from being aware of current events on a global scale. You should pay close attention to the headlines every day because the stock market is affected by decisions both large and minor. But not everyone has a natural inclination to generate quick money by trading every day. Investing in well-known stocks that are expected to rise in value over time is always a safe bet. The longer you have to wait to get the benefits of stock market investing, the lower your returns will be. Putting away a little bit of money each month and letting it compound will help you build up quite a fortune over time. 4. Recency effect. When investors place greater weight on recent occurrences than more long-term trends or precedents, they are exhibiting recency bias. Due to this, investors may assume that a current market downturn will last indefinitely, even if this is not the case. Investors may be influenced by recency bias to put their money into hot stocks that may not be the best choice for them in the long run. Recency bias can be overcome by taking a step back and focusing on the big picture. After a decline, the market tends to recover. In our experience, the days after a significant drop in the market tend to be the greatest days. Putting aside emotions and acting rationally can help you save for the future. 5. Panic buying. Attempting to time the market and buying the hottest stocks are common senses of panic selling. People's stock holdings may be liquidated in a flash if they panic and sell all of their shares at once. The stock price may fall as a result of the heavy selling, which generally leads to even more selling and a lower price. Investors often resort to panic selling as a last-ditch effort to prevent more losses. However, widespread selling in a state of fear causes the stock prices to fall even more. When investors try to prevent a catastrophic loss, they usually end up with just that. Keep your cool if the market starts to freak out. Putting down the newspaper and putting down the portfolio checks is a good start. If you're feeling anxious about your finances, it might be a good idea to get in touch with a financial advisor to get their take on things. 6. accumulating debt and avoiding responsibility. Having student loans, auto payments, credit card debt, and a mortgage can make it hard to know where to start. Indeed, you can't make the debt disappear by ignoring it. In reality, it makes things even worse because it makes interest rates go up and credit ratings go down. As first step to reducing your debt, you should make a list of all of your outstanding balances and the rates of interest for each. Give top priority to the ones where interest rates are exceptionally high, because putting them off will result in a much heavier eventual payment. Debt consolidation loans might help those who are having trouble keeping up with their loan payments due to having too many of them. You'll then only have to worry about making one loan payment every month to one lender at a fixed interest rate. Your interest rate on debt may go down as a result of this. 7. Predicting market movements. When it comes to financial advice, buy low, sell high is unrivaled. While generally sound advice, its literal interpretation can cause unnecessary stress and an unhealthy obsession with predicting market movements for some investors. Instead of attempting to time the market and buy the best stocks at the lowest prices, we think it's better to invest steadily over time and let the growth carry you through to retirement. As a bonus, investing with a long-term horizon increases the likelihood of achieving lasting success. Plan for the accumulation of wealth over time rather than expecting a windfall. 8. Taking on excessive risk as retirement approaches. There are safer and riskier ways to invest your money. The returns on investments tend to be higher for those that carry a higher degree of risk. If you're getting close to retirement age and you haven't saved enough, it can be tempting to invest in high-risk, high-return assets to compensate for lost time. However, it's impossible to quickly amass enough savings to guarantee your financial security. Consider putting the bulk of your retirement savings into low-risk assets a few years before you want to retire. If your finances aren't where you want them to be, it's a good idea to consult a financial planner to find out what steps you should take. 9. Being overly conservative at a young age. If you started investing at a young age, you have more time to accrue a sizable nest egg, courtesy of compound interest and time. Many younger investors may choose to seek safety in numbers by purchasing bonds rather than stocks during times of market uncertainty. Assets with a lower risk typically have a reduced rate of profit. You probably won't lose much money on your trade, but you also probably won't make much either. With more time before retirement, you can afford to take calculated risks in your youth, such as investing in stocks with the hope of earning a better rate of return. And number 10, take advantage of investment automation. Set up automatic payments into a retirement fund to make savings for the future less of a hassle. Put money into your account regularly by having the amount you choose taken out of each paycheck. Whether retirement is a few years or several decades away, making your payments automatic guarantees that you will save for the future. It's already been taken care of, so you don't even have to consider what you're putting away. The process of making regular payments can be automated in several ways. It may be as simple as making an appointment with HR if your company offers a retirement plan. In addition to any plans offered at work, you can set up direct debits from your bank account every time you get paid. The bottom line: we can all agree that mistakes are inevitable, but things go wrong when you refuse to grow from your experiences. Knowing the potential pitfalls will allow you to better prepare your finances. You want to maximize your assets, so don't make decisions based on how you feel. Once you've taken the initiative to register an account and perhaps even begin making contributions, it's important to monitor your holdings frequently to ensure that your money is growing and working hard for you. If you're unsure about your investment decisions, it may be wise to seek a financial professional such as a planner or advisor. Okay, investors, or soon-to-be investors, it's time to end the video here. We hope you found this video informative. If you've experienced any of these mistakes, then share your thoughts in the comment section below. But before that, give a thumbs up to this video and share it. Also, subscribe to our channel for more amazing content.